All right. Thank you, Quinn, and thanks for joining us today. Obviously, with the markets being volatile lately, this is a topic that we wanted to cover since we know it's been on your mind, been on our minds too. And so just so you know what to expect, this is going to be two parts. First, just looking at the basis for how we make long-term projections, the strength of your retirement plan, what kind of spending is sustainable. This is rooted in the Monte Carlo analysis that we'll look at a little bit. And then getting into how we use that analysis to determine if changes need to be made, and then the magnitude of adjustments that would be needed to keep a financial plan, likely to be a success. And so to get started, I thought it might just be good to look at how we come to the conclusion with a client that their financial plan is a good one. And so, maybe the most simple way to create a retirement plan would just be go into Excel, enter your account balance, factor in some savings while you're working, spending and withdrawals that are needed for retirement, and then apply some standard growth rate. And so just for example, it might be a 55-year-old couple who plans to retire at 65, and they're comfortable assuming a 6% growth rate every year on their retirement savings. If you graph the balance of their retirement account over time, it might look something like this. And this type of analysis might be valuable. If it shows your account going to zero in 10 years, it's probably a sign that you should reconsider some elements of the plan. Likewise, if you just see assets increasing exponentially, it's probably a sign that the plan's strong, or even that you're, maybe underspending by a lot. But where this type of analysis fails is that the average growth rate assumption is not really realistic. And while a 6% average annual return might be safe to assume and historically accurate, we know that the market just doesn't tend to work that way. The long-term returns over your life might end up averaging something like 6%, but it's very rare and very unlikely that the market's actually going to return 6% every year. And we see this in times like the last few years where instead of 6% or 8%, the market's up 20%, then down 20%. And in the long run, it averages out to be 6%. But at the time, it doesn't feel like we're living in very average times. And when you consider the variations in returns that produce that 6% return, things start to look very different for the same, scenario, same retired couple. And so that chart that we were just looking at, I added a few lines here that showed different sequences of returns that still all average out to that same 6%. But you can see that your retirement can look very different depending on how those returns, in any single year fall. You can imagine that the retiree shown here in the yellow line, where they have a period of strong returns in their late 60s, and then poor returns later in life, has a very different retirement experience than the investor shown in the gray line here, who has the same average returns, but has poor returns at a different time in retirement. And so this is just an example of a few different scenarios, just adding a few kind of manually to the plan. Still, you can imagine doesn't cover the wide range of returns that we would like. And so with the power of computers now, we can do this, many, many times. And that type of simulation, running thousands of scenarios, is called Monte Carlo analysis. And this is great at giving us a real idea of the range of possible outcomes and their likelihood for a scenario that can have a lot of variation in the inputs, like annual stock market returns, for example. And this type of analysis is nothing new or groundbreaking. In fact, I think it's much more established in uses outside of the finance industry. As old as, the modern version of using computers was originally developed in World War II for the Manhattan Project to predict reactions between neutrons and fission material for making, a nuclear bomb. And, while physicists knew how elements like uranium worked on average, they could never predict, exactly when an atom was going to sorry, they can never predict exactly when an atom was going to decay. And so they needed to run a lot of simulations to determine how much material they needed to make it very likely that this bomb was going to work. And so I give that example just because I think, believe it or not, it relates very closely to our experience in the stock market. We have 200 years of history for the US market, about 600 years of history with the international stock market. We can be pretty confident that over really long periods of time, you're going to get a certain average return. But like the physicists that can't predict, exactly when an individual atom is going to undergo nuclear decay, we can't predict any single year return for the stock market. So we run simulations enough times to give us a degree of confidence that what we're doing will get you where you want to be a vast majority of the time. We don't want to just make sure you have enough to retire in one specific scenario or even the average scenario. Just like the physicists in World War II didn't want to make a bomb that just maybe might go off if everything falls into place right. We want to make sure that, for example, 90% of the time we get the desired outcome. And this chart on the right here just shows you an example of an output of a Monte Carlo simulation for a sample retirement portfolio. You can see an average type of return with the dark blue line in the middle, but then regions of possible outcomes that are statistically possible and the range that those have. And so when building this kind of simulation, how do we know that our scenarios, thousands of scenarios that were run, are realistic in the first place? We're putting a lot of confidence in these projections. We're using this to tell you to feel confident to keep spending even in times like this one, maybe still retire this year if you want to. So I think it's important to know that these trials are based on long-term data of returns, and then also the standard deviation of those returns over time. And you can think of standard deviation just as the volatility in the market. Every investment in your portfolio has these values, but just for example, US stocks have had a long-term return of annually just over 10% on average. And we can also calculate the variability of that return. It's been much more, much less. We know it's not 10.1% every year. We know that there's this range of outcomes. And with that historic data, we can assign probabilities of certain returns happening. And I'm obviously not going to go into a ton of details here and make it a statistics course, but with a couple of assumptions, like assuming the stock market falls and the returns of the stock market fall in a normal distribution, that's that kind of bell curve shape that we've all seen. This historic data that we have gives us really realistic inputs to have the Monte Carlo simulation run. And again, this is just using US large cap stocks as an example. With their historical volatility, we plug in these percentage probabilities of different returns. And so exactly what this means, just so you know, in these trials that we're running, for example, for 1,000 trials, 136 of those, or 13.6%, include a return somewhere between negative 20.5 to negative 5%. There's different standard deviations or different likelihoods of outcomes occurring that's shown in this graph here. But I think you get the point. So now we can be sure that of our thousands of trials that are being run, they're really based on realistic, probable outcomes. And just to bring this back to reality, this is what we see when we look at those 200 years of US stock market returns. This is just a plot of annual stock market returns. Each yellow brick here is for a single year, and the bricks are grouped with other years that have had similar annual returns. And so just for example, the year 2015, shown here at the top, had a return somewhere in that 0 to 10% range. And so it's grouped with everything else. And we see on average, it's much more likely we get a return in that one standard deviation range, the middle of the graph here. than it is in 2 or 3 standard deviation events. Those are the big moves like 30 or 40%, up or down. And so really this is just a different way of showing what that last slide did, using much more specific information. And so that calculation gets run for every investment in your portfolio. Emerging markets, stocks have much higher volatility, so we factor that in. Bonds have lower volatility and lower expected returns. And we end up with it all coming together to create that graph we've been looking at here. And so just the first thing we like to point out, covering that to people that are worried about these short-term moves in the stock market that we see today, is that these types of moves are in our underlying assumptions. Today's volatility is not something, out of the blue that we never were counting on happening. In fact, we knew for sure that this was going to happen sometime in retirement. And so with all that, we give you a snapshot, this Monte Carlo number with today's values that just for example, there's a 91% chance that you could get through retirement without ever needing to cut a dime from your spending. But while the Monte Carlo number that we show you is just a snapshot for that moment in time, we know that really financial planning is dynamic. We can make changes. Your future spending is not, carved in stone and required that you follow it to a T. You're not on you don't set a course that guarantees 9% of the time you're living on your kid's couch in retirement or something like that. So because of that, a lot of people rephrase the term probability of success into something different like probability of adjustment. Because in reality, we would not just sit idle and watch your portfolio go to zero. So what that Monte Carlo is maybe more accurately showing is that 9% of the time, you would have had to make some changes to your spending to keep that plan successful, to prevent you from fully depleting that portfolio. And that's a little easier said than done because we don't know, if today's decline is for sure one of those 9% of times, or if it's, already assumed, but one of the successful scenarios. And so we try to be proactive instead of, waiting for long periods of time and letting your portfolio, maybe follow these lower tracks here, be on a scenario more likely to be depleted. We try to monitor this frequently and recommend adjustments to your spending to be really conservative and make sure we're keeping you out of those 9% of scenarios. And how we think of this, or what it kind of looks like, is maybe something like this. We call it like retirement guardrails, and just like bowling, for example, the guardrails you can set up in the gutters to direct the ball one way or another if it gets too far off the side. It's the same principle with this, where if we see your portfolio drop enough that causes a decline in that Monte Carlo score, we can make small changes now, we're early in the plan, that can make sure we're keeping you up towards maybe average, keeping you up where you're comfortable. And again, so while that one Monte Carlo is just a snapshot, we keep running it over time. As the market continues to rise and fall, we can recommend small changes to spending that get you out of potential scenarios that have a higher probability of later in retirement being somewhere where you don't want to be. And so I thought it'd be good just to give a real life example, kind of real numbers in our financial planning software to show you what this looks like, because a lot of times the changes that need to be made are much smaller than people worry about, even if we get a historic decline like we see today. And so, for example, put some numbers here just for a married couple, age 65. They're retired, have $4,500 a month combined in Social Security benefits, and have a little over $1 million in IRA assets that are split in that 60-40 stock bond allocation. And then they want to spend $8,000 per month in retirement. And so, we meet with them, build that plan, and give them a specific Monte Carlo, number. And for example, this is where that 91% that we've been looking at has come from. But now, the market declines, maybe like we're seeing today. Just as they're retired, that 60-40 portfolio goes down about 17%. So this is just a little worse than the decline we're seeing today for that asset allocation. But just to put it in perspective, now we're monitoring this Monte Carlo, and we see that it's starting to get in a range where it might be good to start making small changes to, again, just ensure we're staying off that lower bound, not setting you up for being in a situation in the long term that is harder to get out of. And so just for example, for this hypothetical client here, we can come and say, you had a goal of spending $8,000. If while the market's down, we change that to $7,700 per month, so cutting $300 per month, that gets you back in a very confident long-term scenario that we're comfortable seeing. And so again, this is real numbers here, exactly how our financial planning software would show it. And for this client spending, about $96,000 per year, just cutting by $300 a month, a relatively small amount, has a very significant impact in their plan and does a lot to really kind of move the needle and get them back up into that zone that we want them to be. And so I just show this mainly because we find that a lot of people are really worried, thinking that, with a decline like we're seeing today, they'd have to cut thousands and thousands of dollars per month in their spending. And that's just usually not the case. And, by the way, this also works both ways too. Of course, right now, everyone's worried with the market dropping, but the market can go up too, believe it or not. And this applies on that for that same principle as well, maybe that upper guardrail instead of the lower guardrail. And so we can go to this client, maybe we have a very good year in the stock market, that IRA rises a certain amount up to, for example, 1.6 million. And now we can go to them and say, hey, if you want to increase your spending, you can be very confident in doing that. And so, feel free, here's $800 a month more. You're still at a very high probability of success. And, they can hopefully enjoy retirement, not have to worry about being too conservative over time. And so just as an example, here's what this looks like when for clients, maybe we'll meet with you this fall or in future spring meeting. Even when the market isn't crazy, this is something that we like to have in place for when we're meeting with you regularly, so that you have an idea of what those guardrails are. If your portfolio falls to a certain amount, here's what we would do. That way, even in normal times, that it doesn't come out of left field that we'd recommend a small reduction in spending. And you also know what the changes are going to be. This has been good for, people we looked at this a year ago. They were comforted knowing even if we get a big decline like we've seen today, we won't have to make a change, or it would be very small. So I just wanted to show an example here of how some of you guys will see this in the future when we talk with you about it. So just kind of to summarize here, first is to know that planning is dynamic. Monte Carlo is a snapshot and very useful on its own, but putting too much faith in a reading of 99% or even 50% for that matter for any specific day is maybe not the right thing to do, because in reality your plan changes every day, every year. And this is why we will reach out to meet with you this fall and next spring for a meeting, so that you can be comfortable about your plan. What to expect, where the guardrails are, changes that would have to happen. And we also like to point out that we do use Monte Carlo analysis. It is a very good way to do retirement planning, but it does add a conservative element to your plan. And unlike that basic Excel spreadsheet model that we started with, it assumes that these types of declines are going to occur. And then it assumes that they happen again, in the future. So if we're running a Monte Carlo analysis for a client today, it's already at, what is relatively depressed levels of your portfolio. And it's assuming that there's those chances that this decline happens again, which, historically, if the markets drop 20%, it doesn't fall 20% again right away. But Monte Carlo is going to assume that wide range of results is possible and reflect that. And so what we covered here was just some general examples, but it can be tailored to you. If you're comfortable with different possibilities of varying expenses in retirement, a lower probability is perfectly fine to plan around. If you have high fixed costs, maybe medical costs or something like that, we might want to keep a higher percent of probability of success in the plan, just knowing that there's not that flexibility. And so this is just a few examples, but really this type of analysis gets tailored to you to make sure it's right for you. And then lastly, if you get anything out of this, we hope seeing just some real examples helps knowing the magnitude of changes that can be made to have a really big impact. And, we think this is the real benefit of just kind of that ongoing financial planning. We can stay on top of this with you, recommend, relatively small changes over time to make sure that in the long run, you're on a very sustainable path. And with that, that's all we had prepared for today. Thanks again for joining us here. Sorry about my cough, but appreciate it. And if you have any questions, please let us know. Otherwise, have a great rest of your weekend.